Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Horizon Oil. Before I introduce our speakers, a few points to note. Please submit your questions in the question box to the left of the slides. If you're interested in scheduling a meeting with Horizon Oil, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Richard Beeman, Chief Executive Officer, and Kyle Keen, CFO of Horizon Oil, which trades on the OTCQB venture market under the symbol HZNFF and on the ASX on the symbol HZN. Welcome, Richard and Kyle.
Thanks, Cecilia, and good afternoon, everyone. Look, at Horizon, we are a low-cost conventional oil producer generating significant cash flow, which is predominantly being returned to shareholders, while still continuing to invest in low-risk production growth focused in and around our existing assets in order to generate maximum value for shareholders. So let me and Kyle take you through the story and the results we are delivering. Before I dive in, please note that all references to dollars are US dollars unless otherwise stated. During the course of this presentation, we'll be making some forward-looking statements, and while we take every care in the preparation of these statements, actual results may materially differ depending on a variety of factors, and so I encourage you to read the disclaimer in full. So on to who we are and our strategy. Horizon is an Australian-based company which is focused on low-cost conventional oil production of currently approximately 5,000 barrels of oil per day net from oil fields located in China and New Zealand. We have a 26.95% non-operated interest in Block 2212 offshore China and a 26% non-operated holding in the MAARI field offshore New Zealand. We have a strong balance sheet with net cash of over $25 million as at 31 December 2022, and a history of returns to shareholders, having returned over 70% of free cash flow over the past 2 years, which once you include our recently announced 1.5 Australian cents per share interim dividend, total over $75 million US dollars, which is over 40% of our current market capitalization. Horizon's company strategy is simple. We aim to maximize free cash flow from our current assets. We are focused on shareholder returns and making distributions to shareholders. We will continue to invest in production growth, focused in and around our existing assets, keeping an eye out for exceptional new business opportunities. Importantly, we are delivering on this strategy, with strong cash flow generation throughout the half year to 31 December, resulting in EBITDAX of $52.2 million generated in just 6 months. Cash flow generation was turbocharged over recent months, following the very successful drilling campaign in our China oil fields, where production rates reached record levels. Our ability to generate and sustain high cash flows from our assets is due to the very low cash operating costs, which continued to be maintained below $20 a barrel. All of our crude oil is sold with reference to dated Brent, and we receive significant premiums on our New Zealand oil sold. The sustained strong cash flow generation from our assets has allowed us to distribute or announce distributions totaling over $45 million US dollars over the past 6 months, with distributions paid in October last year of 3 Australian cents per share, and a recently announced interim dividend for the half year of 1.5 Australian cents per share, which is to be paid in April. Our distribution history over the past few years has represented roughly an annualized return of 20% per annum. Notwithstanding these distributions, we are continuing to invest in production growth, with a key milestone achieved last year with the commissioning of the 12-8 East oil field in China. Further investment continues, with additional low-risk, high-return infill drilling being progressed and potential for life extension at our New Zealand fields being investigated. Looking at our asset portfolio in more detail, set out here is a summary of our two assets. Block 2212, located offshore China in the BEIBU Gulf, which has been producing since 2013, and the MAARI field, located offshore New Zealand, which has been in production since 2009. We have strong joint venture partners and quality operators, with our China fields contributing approximately 80% of the group's production, with New Zealand contributing around 20%. Now, this is a snapshot of the company's recent share price history. We have a market capitalisation of approximately 250 million Australian dollars, or around 170 million US dollars. The chart shows share price movement since January 2022. Horizon share price in the orange rather, the oil price in the green, and the ASX energy index in grey. The chart clearly shows the linkage with oil price for the first 6 months, with the outperformance since mid-2022 largely associated with the strong production growth from our China oil fields, punctuated by our distributions to shareholders. As you would expect, we have been highly leveraged to the oil price and pleasingly have exceeded the ASX 200 energy index. We have a supportive shareholder base with some large long-term holders. I will now pass over to Kyle to run through some of the half-year financial highlights before providing some more detail around our production assets and the outlook.
Thanks, Richard. This slide summarises the half-year 23 results with a comparison against the prior half-year. As Richard has mentioned, the half-year results were strong, with significant increases in all key metrics owed to both production growth and a higher average realised oil price during the half-year. Production volumes increased 40% as a result of the successful execution of both Phase 1 and Phase 2 of the 12 East development, as well as 2 infill wells and a multi-well workover program in the 612 fields in Block 2212. Revenue increased 93%, despite the deferral of a scheduled MAARI lifting to early January 2023. The higher revenue was of course driven by the 40% increase in production and a 30% increase in realised oil prices to just under $95 a barrel. The increased revenue, combined with maintenance of cash operating costs below $20 a barrel, drove a surge in EBITDAX to $52 million, which on an annualized basis, the company trades on an EV/EBITDAX multiple of less than 2. This cash flow helped to rebuild the company's cash position to just over $40 million at period end, following a substantial 3 cents in distributions paid to shareholders during the period, which resulted in cash outflow of $30 million. Pleasingly, we exited the period with a strong balance sheet, with net cash of just under $25 million. On the right of the slide, we have the 5-year history of the company's net cash, net debt position. Here we can see how the strong and sustained free cash flow generation from the group's assets has driven consistent and sustained debt reduction from a net debt position of just over $64 million at the end of calendar year 2018 to a strong net cash position of $24.8 million in only 4 years, after cumulative distributions of just under $65 million. That represents free cash flow generation over a 4-year period of approximately $150 million US dollars, notwithstanding the depressed oil price environment during the calendar year 2020. Our focus is to continue to drive this free cash flow generation from our assets out into the future by extracting maximum value from these assets. The resilience of this cash flow, high oil prices, and a strong production result provided the confidence to declare Horizon's first interim distribution last month and continue to return significant value to our shareholders. I will now pass over to Richard to provide an operational update on our asset portfolio and an outlook for the company.
Thanks, Kyle. Operationally, the half year was a period of significant achievements. A new development, the 12-8 East project in China, was successfully completed, with 10 wells progressively brought onto production since April 2022, almost doubling production from Block 2212 to a record high in December of over 20,000 barrels of oil per day gross, or over 5,000 barrels of oil per day net to Horizon. Production from these fields exceeded pre-drill estimates, leading to a recent material reserve upgrade. Successful infill drilling in Block 2212 and workover activities at both MAARI and Block 2212 also boosted production rates. The combined daily production rate from Horizon's share of both Block 2212 and MAARI averaged over 5,000 barrels of oil per day during the half year, an increase of over 35% from the average production rate achieved during the 2022 financial year. On ESG, despite the elevated activity levels, we have continued to uphold a strong safety record, significantly better than industry benchmarks. And specifically on climate change, having declared an ambition to reach net zero emissions by 2050 in early 2022, we recently made a modest investment of seed capital in a carbon removal credit developer called Nobrac Limited to aid with the group's longer-term decarbonisation ambitions and to act as a natural hedge against the growing carbon emission costs incurred at MAARI under the New Zealand Emissions Trading Scheme. Importantly, the investment presents an opportunity to deliver an additional cash flow stream and provide further value for shareholders. So now turning to our producing assets, starting with Block 22/12 in China. Block 22/12 production currently comes from up to 30 wells, which have been drilled from 3 wellhead platforms contained in the 3 production areas highlighted in the green rectangles on this slide. These platforms are tied back to a central processing platform where crude oil is metered and effectively sold before entering a pipeline back to the Weizhou Island terminal. The crude oil is sold domestically within China, with sales revenue paid monthly in US dollars directly offshore. The crude oil is sold with reference to dated Brent with a few dollar discount. While historical production has been dominated by the Weizhou 612 and 128 West fields, the 128 East field in the bottom right-hand side of the graphic is the most recent addition to our production base, having only come onto production in April last year. Since the start of production in 2013, the oil rate from the whole block has been maintained between 8,000 to 10,000 barrels of oil per day gross by undertaking a number of incremental activities such as infill drilling. Recently, we have been able to materially increase production from the asset to an average of over 15,000 barrels of oil per day gross by bringing on the 128 East field. Whilst we expect production rates to naturally decline, our objective is to continue to develop the material pipeline of infill and near-field drilling opportunities to maintain oil rates well above the long-term average of around 10,000 barrels of oil per day gross. These fields currently generate approximately 80% of Horizon's cash flow, due in part to the very low cash operating costs, which were maintained at approximately $11.50 per barrel during the half year. Now, looking at the newly completed 128 East development in more detail, the 3D diagram on the right in this slide illustrates the main elements of the development: 10 producing wells and 1 water disposal well. The development includes a self-installing processing and wellhead platform and an export pipeline tied back to the existing 128 West platform. As mentioned, the project was successfully commissioned and brought onto production in April 2022. Impressively, the joint venture were able to interpret early production results from the project in the middle of the 2022 calendar year and fast-track the drilling of 4 additional production wells in a matter of only a few months. The strong initial production results, combined with the additional 4 wells, led to a material reserve upgrade earlier this year. The success of the project is highlighted by the rapid payback, with Horizon's total investment in 128 East of around $30 million, on track for full payback within 12 months of first production. Importantly, the success of the project and the strong production results paved the way for consideration of additional infill wells to be drilled in the fields, with one initial target being considered for drilling later this calendar year. Now, looking to the history of this asset and our view of its future, this chart reflects our current 2P reserves forecast in the dark green. The production history is in the light green, and if we extended this back, you would see consistent production at or about 10,000 barrels of oil per day, which has been a hallmark of the success of Block 22/12 over many years, where production rates have been largely maintained through low-cost infill drilling, workovers, and water handling upgrades. The chart shows the indicative future production potential from the fields, with the natural decline profile largely representative of the current value inherent in the share price. The blue sawtooth profile is the additional production potential and value to be unlocked from future activities and represent current identified opportunities in the block. Pleasingly, the success of the 12-8 East project has opened up a number of additional opportunities which are now being considered. As stated on the slide, the indicative cost of unlocking the blue shaded area in this chart is in the order of $10 to $15 million net to Horizon per annum over the next 3 to 5 years. I would emphasise that all of the indicative future activities remain subject to further technical and economic evaluation and subject to JV and regulatory approvals. So now on to our other asset. MAARI continues to be an important asset for Horizon, generating around 20% of Horizon's cash flow. The field includes a wellhead platform tied back to an FPSO, with shuttle tankers performing offtakes every 3 to 4 months. MAARI crude attracts strong premiums to dated Brent, with deliveries mainly into East Coast Australia. Over the past few years, the production decline rate at MAARI has been arrested through continued water injection and well optimization, and production rates are expected to be sustained without the need for significant capex spend. Our operating costs are modest in the context of the current oil price, and as a result, the asset is highly cash generative. Our immediate focus is on low-cost, high-value well workovers and water injection optimization in order to reinstate and enhance production rates, with consideration for field life extension being evaluated. The chart on this slide reflects our current MAARI forecast in the dark green, which, as you can see, is expected to exhibit a more modest decline when compared to that of Block 2212. Whilst we've included indicative future activities in light blue, these would likely require a significant capex expenditure commitment and permit extension to be commercially viable, such that most of our current efforts are focused on lower cost production optimization works and workover activity, with the objective of maintaining current production rates. We see significant value in simply extending the permit by up to 5 years to maximise value from the current well stock, i.e. unlocking the dark blue profile. As I mentioned, the immediate focus is on workovers to reinstate production from currently shut-in wells, as well as to enhance production rates through the conversion of a well to a permanent water injector. The table sets out the timing of operational activity on this slide over the period until early into 2024. Please note that the timetable is indicative and most of the activities remain subject to further technical and economic evaluation, joint venture and regulatory approvals. In total, we have between 2 and 5 infill wells in Block 2212, which are being matured, with the possibility of some or all of these being drilled towards the end of the calendar year. Upgrades to water handling capacity at Block 2212 is also being prioritised, particularly for the 12-8 East project, as the more water we can manage, the higher the production rates we can sustain. Further infill well opportunities in a possible 12-8 East Phase 3 drilling program is being considered, with the possibility of drilling these in future years. As mentioned, at MAARI we have 2 immediate workover priorities, which are aimed at reinstating production from the currently shut-in wells. This in addition to the permanent conversion of a well to a water injector, which should aid in sustaining production levels from the main MAARI Moki reservoir. Other activity at MAARI is focused on life extension, with the venture evaluating opportunities to extend the licence beyond 2027, progressing decommissioning studies and examining other value accretive opportunities. So in looking forward and keeping with the key elements of our strategy, we plan to capitalise on our recent production growth to maximise free cash flow generation and maximise shareholder returns. To ensure these returns can be sustained, we will continue to invest in further production growth within our existing assets, whilst also looking out for new business opportunities. Now, to further aid investors, we recently released full year guidance for the financial year ended 30 June 2023, which is displayed on the next slide, which Kyle will talk to.
Notwithstanding the recent crude oil volatility, we're anticipating a strong end to the financial year, driven by higher production levels out of Block 22/12. We therefore have production guidance net to Horizon of 1.85 to 1.5 million barrels, which would be a record for the company. Sales, we expect to also be in the range of 1.85 to 1.95 million barrels, similar to our production due to forecast timing of MAARI liftings. And at current oil prices, we anticipate revenue towards the bottom end of our guidance range at around 155 million, with EBITDAX of around 105 million. So, in summary, Horizon has had a strong half year, delivering significant value to our shareholders. The outlook remains positive as our low production costs and material positions in high-quality assets provide significant leverage to the oil price and aids us in generating strong cash flows. We have a strong balance sheet and a commitment and determination in delivering value to our shareholders, having distributed some $75 million in distributions in the past 2 years. Thank you for your time today, and Richard and I are happy to take any questions.
Okay, so the first question we have is, can you speak to your hedging and debt?
I can. We have fairly modest debt levels. I mentioned we've got a net cash position of 25 million at the end of the half year of December, but the actual level of debt at that point was around about $15 million, which is due to be repaid by just after the middle of the year. In terms of hedging levels, we don't have any current hedging on foot. We have historically had a fairly judicious hedging program, but it's been very much focused on hedging to be able to meet our future commitments, particularly debt repayments and capital commitments. But at this time, with fairly modest debt levels, the company being in a net cash position, and with very, very low capex commitments going forward, we don't have any particular hedging on foot at the moment.
Thank you, Richard. The next question we have here is, what are the drivers for your low operating costs?
It's fundamentally probably the focus. You got to look between the two different assets. In China, our operating costs are, as I mentioned, around about $12 a barrel. We have infrastructure in the field which essentially ties us back through to pipelines, and we've got processing platforms which are fixed. We have tariffs that we pay in order to process the crude oil and for utilising the pipeline. But essentially, because we have all that fixed infrastructure where we invested historically, the ongoing operating cost structure there is fairly modest. New Zealand's slightly more expensive, as I mentioned, around $30 to $35 a barrel. There it's a little bit higher because we've got a sort of a standalone facility with an FPSO sitting about 80 k's offshore the New Zealand coastline, so that makes the cost structure there a little bit higher. But again, we've invested, and so we own all the core infrastructure, which allows us to keep the costs considerably down.
Thanks for that. The next question we have is, what can shareholders expect in terms of distributions for the coming year?
Look, whilst we don't issue any guidance with regards to distribution, I mean, if you look at the past 2 years, we have a history of returning a significant proportion of the cash generated by the company. It's core to our strategy, and we most certainly look to continue to do that.
Thanks, Kyle. Final one is, what is our ownership structure?
So look, we're an Australian listed company and listed on the ASX here in particular. We have an ownership structure where we have two larger shareholders. One, a long-term shareholder, private company based up in Asia, which owns about 25% of the company. And we also have a domestic fund in Australia which holds another 20%. Beyond that, then it's really a mixture of institutional funds and retail shareholders, and management, which hold the remaining sort of 55% of the shares.
Okay, so I think that concludes the questions. If you have any further questions, feel free to either schedule a meeting with us or send your questions through to info@horizonoil.com.au. I'd like to thank your participation in our virtual investor conference for today.